Welcome to Wonderslate. Subscribe to our YouTube channel for more updates. Topic for today's video is History of Banking in India. History of Banking in India. The banking sector development can be divided. Phase 1, the early phase which lasted from 1770 to 1969. Phase 2, the nationalization phase which lasted from 1969 to 1991. Phase 3, the liberalization or the banking sector reforms phase which began in 1991 and continues to flourish till date. Pre-independence period, 1786 to 1947. The first Bank of India was the Bank of Hindustan, established in 1770 and located in the then Indian capital Calcutta. However, this bank failed to work and ceased operations in 1832. During the pre-independence period, over 600 banks had been registered in the country, but only a few managed to survive. Following the path of Bank of Hindustan, various other banks were established in India. They were the General Bank of India, 1786 to 1791, Out Commercial Bank, 1881 to 1958, Bank of Bengal, 1809, Bank of Bombay, 1840, Bank of Madras, 1843. During the British rule in India, the East India Company had established three banks, Bank of Bengal, Bank of Bombay and Bank of Madras, and called them the Presidential Banks. These three banks were later merged into one single bank in 1921, which was called the Imperial Bank of India. Allahabad Bank, Punjab National Bank, Bank of India, Central Bank of India and Canara Bank, Bank of Baroda were established during the pre-independence period. Post-independence period, 1947 to 1991. At the time, when India got independence, all the major banks of the country were led privately, which was a cause of concern as the people belonging to rural areas were still dependent on money lenders for financial assistance. With an aim to solve this problem, the then government decided to nationalize the banks. These banks were nationalized under the Banking Regulation Act, 1949. Whereas, the Reserve Bank of India was nationalized in 1949. Government decided to nationalize the banks. These banks were nationalized under the Banking Regulation Act, 1949. Whereas, the Reserve Bank of India was nationalized in 1949. Following it was the formation of State Bank of India in 1955 and other 14 banks were nationalized between the time duration of 1969 to 1991. These were the banks whose national deposits were more than 50 crores. In the year 1980, another 6 banks were nationalized, taking the number to 20 banks. These banks were included. Apart from the 20 banks, there were 7 subsidiaries of SBI which were nationalized in 1959. All these banks were later merged with the State Bank of India in 2017, except for the State Bank of Saurashtra, which was merged in 2008, and State Bank of Indore, which was merged in 2010. Impact of nationalization. There were various reasons why the government chose to nationalize the banks. This led to an increase in funds and thereby increasing the economic condition of the country. Helped in boosting the rural and agricultural sector of the country. It opened up a major employment opportunity for the people. The government used profit gained by banks for the betterment of the people. The competition was decreased, and work efficiency had increased. This post-independence phase was the one that led to major developments in the banking sector of India and also in the evolution of the banking sector. Liberalization period, 1991 till date. Once the banks were established in the country, regular monitoring and regulations need to be followed to continue the profits provided by the banking sector. The last phase or the ongoing phase of the banking sector development plays a significant role. The biggest development was the introduction of private sector banks in India. RBI gave license to 10 private sector banks to establish themselves in the country. The other measures taken include: the committee announced that RBI and government would treat both public and private sector banks equally. Any foreign bank could start joint ventures with Indian banks. The committee announced that RBI and government would treat both public and private sector banks equally. Any foreign bank could start joint ventures with Indian banks. Payments banks were introduced with the development in the field of banking and technology. Small finance banks were allowed to set their branches across India. A major part of Indian banking moved online with internet banking and apps available for fund transfer. Important functions of bank. There are two types of functions of banks. Primary functions, being primary, are also called banking functions. Secondary functions. All banks have to perform two major primary functions, namely accepting of deposits, granting of loans and advances. Primary functions of bank. All banks have to perform two major primary functions, namely accepting of deposits, granting of loans and advances. A very basic yet important function of all the commercial banks is mobilizing public funds, providing safe custody of savings and interest on the savings to depositors. Bank accepts different types of deposits from the public, such as saving deposits, fixed deposits, current deposits, recurring deposits. The deposits accepted from the public are utilized by the banks to advance loans to the businesses and individuals to meet their uncertainties. Bank charges a higher rate of interest on loans and advances than what it pays on deposits. The difference between the lending interest rate and interest rate for deposits is bank profit. Bank offers the following types of loans and advances: bank overdraft, cash credits, loans, discounting the bill of exchange. Secondary functions of bank. Like primary functions of bank, the secondary functions are also classified into two parts: agency functions, utility functions. Banks are the agents for their customers, hence it has to perform various agency functions. Transfer of funds, transferring of funds from one branch/place to another. Periodic collections, collecting dividend, salary, pension, and similar periodic collections on the client's behalf. Periodic payments, making periodic payments of rents, electricity bills, etc. on behalf of the client. Collection of checks, like collecting money from the bills of exchanges. The bank collects the money of the checks through the clearing section of its customers. Portfolio management, banks manage the portfolio of their clients. It undertakes the activity to purchase and sell the shares and debentures of the clients and debits or credits the account. Other agency functions. Under this, bank acts as a representative of its clients for other institutions. It acts as an executor, trustee, administrators, advisors, etc. of the client, issuing letters of credit, traveler's check, etc., undertaking safe custody of valuables, important documents, and securities by providing safe deposit vaults or lockers, providing customers with facilities of foreign exchange dealings, underwriting of shares and debentures, dealing in foreign exchanges, social, welfare programs, project reports, standing guarantee on behalf of its customers, etc. Types of banks. Banks can be classified into various types. Given below is the bank types in India: central bank, cooperative banks, commercial banks, regional rural banks, RRB, local area banks, LAB, specialized banks, small finance banks, payments banks. The main function of the central bank is to act as the government's bank and guide and regulate the other banking institutions in the country. Given below are the functions of the central bank of a country: guiding other banks, issuing currency, implementing the monetary policies, supervisor of the financial system. These banks are organized under the State Governments Act. They give short-term loans to the agriculture sector and other allied activities. The main goal of cooperative banks is to promote social welfare by providing concessional loans. Types of banks. Cooperative banks are organized in the three-tier structure. Tier 1, state level, state cooperative banks, regulated by RBI, state government, NABARD. Tier 2, district level, central or district cooperative banks. Tier 3, village level, primary agriculture cooperative banks. Types of banks. Commercial banks operate on a commercial basis and its main objective is profit. They have a unified structure and are owned by the government, state, or any private entity. They tend to all sectors ranging from rural to urban. These banks do not charge concessional interest rates unless instructed by the RBI. Public deposits are the main source of funds for these banks. The commercial banks can be further divided into three categories. Public sector banks, a bank where the majority stakes are owned by the government or the central bank of the country. Private sector banks, a bank where the majority stakes are owned by a private organization or an individual or a group of people. Foreign banks, the banks with their headquarters in foreign countries and branches in our country, fall under this type of bank. These are special types of commercial banks that provide concessional credit to agriculture and rural sector. RRBs were established in 1975 and are registered under a Regional Rural Bank Act, 1976. RRBs are joint ventures between the central government, 50%, state government, 15%, and a commercial bank, 35%. 196 RRBs have been established from 1987 to 2005. From 2005 onwards, government started merger of RRBs, thus reducing the number of RRBs to 82. One RRB cannot open its branches in more than 3 geographically connected districts. Introduced in India in the year 1996. These are organized by the private sector. Earning profit is the main objective of local area banks. Local area banks are registered under Companies Act, 1956. At present, there are only 4 local area banks, all which are located in South India. Small Industries Development Bank of India, SIDBI, loan for a small-scale industry or business can be taken from SIDBI. Financing small industries with modern technology and equipments is done with the help of this bank. Exim Bank. Exim Bank stands for Export and Import Bank. To get loans or other financial assistance with exporting or importing goods by foreign countries can be done through this type of bank. National Bank for Agricultural and Rural Development, NABARD. To get any kind of financial assistance for rural, handicraft, village, and agricultural development, people can turn to NABARD. Small finance banks. This type of bank looks after the micro-industries, small farmers, and the unorganized sector of the society by providing them loans and financial assistance. These banks are governed by the central bank of the country. People with an account in the Payments Bank can only deposit an amount of up to Rs 1,00,000/ and cannot apply for loans or credit cards under this account. Options for online banking, mobile banking, the issue of ATM, and debit card can be done through payments banks. Given below is a list of the few payments bank in our country. Indian financial system. The services that are provided to a person by the various financial institutions including banks, insurance companies, pensions, funds, etc. constitute the financial system. It plays a vital role in the economic development of the country as it encourages both savings and investment. It helps in mobilizing and allocating one's savings. It facilitates the expansion of financial institutions and markets. Plays a key role in capital formation. It helps form a link between the investor and the one saving. It is also concerned with the provision of funds. Components of Indian financial system. There are 4 main components of the Indian financial system. This includes financial institutions, financial assets, financial services, and financial markets. The main functions of the financial institutions are: a short-term liability can be converted into a long-term investment. It helps in conversion of a risky investment into a risk-free investment. also acts as a medium of convenience denomination, which means it can match a small deposit with large loans and a large deposit with small loans. Important financial assets are call money, notice money, term money, treasury bills, certificate of deposits, commercial paper. The financial services in India include banking services, insurance services, investment services, and foreign exchange services. The financial market can be further divided into 4 types: capital market, money market, foreign exchange market, and credit market. Thank you for watching the video. If you have any suggestion for us, feel free to leave comments. If you liked the video and want to see more of it, hit the thumbs up and don't forget to click on subscribe button to get more updates of the future videos.